Everybody, thank you so much for joining us today for our May rendition of Coffee with Forethought. Give everybody a second to hop in here with us before we get started. As we do that, quick reminder for you all that this is for informational purposes only. You can see our full disclosures online if you have any questions about that. And speaking of questions, Jake and I will be doing a live Q&A at the end of today's presentation. So at the very bottom of your screen, you should have a very nice little dialog box there that will allow you to type in those questions during our presentation. If it comes up, type it in. Make sure you don't forget it. We'll get to as many as we can. And if we cannot get to your question during our allotted time today, then we will make sure that we have somebody reach out to you afterwards because we want to make sure that we're giving you as much information as we can. So your presenters for today are our regular duo here. So I'm Joel Johnson. For those of you who do not know me, I am Director of Planning here at FourThought, and I am joined, as always, by Jake MacFarlane, our Senior Research Analyst. How are we doing today, Jake?
Hey, good morning, Joel. Good to be with you all and get another coffee with Forethought.
Absolutely. And we've got a busy one on the schedule, and it's going to be very data heavy because we have had a lot of things going on today. So quick agenda of key topics we're going to be touching on. We're going to talk about the hot events of April and even really some of 2026 thus far. We're going to talk, of course, about market performance for the first quarter, what it looked like over the last month, and really dive into that a little bit deeper because Jake and I want to make sure that we have a really good understanding of what people mean when they say the market performing versus what's actually happening in the underlying markets and how that's looking. We're going to talk about key planning indicators, which is, of course, our holy grail. And we're going to finish up with some earnings themes and investing fundamentals because we are knee-deep in earnings season once again. It's one of our ongoing themes, and so we're excited to share some really pretty big, some tech earnings that have happened over the last month with all of you. So let's go ahead and dive right into it, and let's kick it off with key events from April. And of course, we would be remiss if we did not start with the big one that is still on everybody's mind, and that is what is currently happening still in Iran and the Strait of Hormuz and the saga that has continued to unfold there. Now, when this first happened, roughly 2 months ago now, I think, if my calendar is correct, we kind of got in front of everybody and expected this to be what we would call a shorter engagement with Iran. At least that was the hope at the time. And it doesn't seem that that's going to be the case at this point. Now, they are still making some diplomatic efforts towards hopefully that end. But as everybody has noticed, depending on which channel you turn on right now, every day it's a different story about what is actually happening over there. Now, the good news is, relatively speaking, this is still on the shorter end of conflicts that we have seen in the past. We are hoping that it does not continue on for months and months at a time. But one of the things that this is affecting right now is, of course, inflation. With what is happening in the Strait of Hormuz right now, we were hoping that what we would see is a quick spike in oil prices. We would come to some sort of an agreement, and then that would all change over, and we would go back to what would be a more normal oil environment for the companies that we follow and really the world economy as a whole. Jake, I don't know if you have any different thoughts on that, but I think that's probably changed at this point. What we've seen is not only the original spike in oil prices, but because of the escalation that we've seen over the last couple of weeks, a lot of the infrastructure in Iran has now been pretty, if not permanently, severely damaged. That is going to hamper their production of oil for some time to come, which of course is going to put pressure on the supply of oil worldwide, which is going to lead to higher gas and oil prices and potentially higher inflation for longer than I think I personally originally thought. I don't know if you have any different thoughts about that, but that's what I'm keeping an eye on right now when it comes to what's happening over in Iran.
Yeah, I think the data backs it up. It's not, an opinion here, right? If we look at where crude oil finished the month, right about 110 per barrel. If we look at where gas prices, kind of a national average, was above $4 a gallon, like 4.10. It's almost 30% higher than where we started the year. And we've seen oil be a little bit volatile when we get some good news on the negotiating fronts. Going back to the 17th, oil prices dropped 11% in one single day, right? When we were getting on the right path. But I think to your point, I expect it to still be pretty volatile as we get, some news out of the negotiating fronts, which hopefully, we get to some some resolution at some point. But I think to your point, right, like kind of the natural level, even if oil does come down, I don't think we're going back to, where we started the year at or anything like that, just because of, there's some supply that's taken offline and it's going to need to be replaced somewhere else. And demand for oil hasn't really changed. So I could see that as just being at a naturally higher kind of base level now moving forward, which to your point will have an effect on inflation. Absolutely.
Yeah, so it's definitely an evolving situation. I think the story has significantly changed from when it started. It'll continue to change. Folks are starting to talk about leaving OPEC, which is going to have some impact. So it's very much a developing thing, but we're going to dive deeper into that in just a second when we get to the economy and what we're seeing there. But that's a really good lead in into Q1's earnings season. And Jake, I know later in the presentation we're going to go over some specific companies, but give us some highlights. What have you seen so far when digging into those reports and the report cards from our companies?
Yeah, I think that's kind of goes in the face of what we've seen from a geopolitical standpoint. It's kind of been the positive surprise of the month, despite all the chaos that's happened there. Corporate earnings continue to come in pretty strong. We'll dig into some company specifics and also just kind of broad thoughts on earnings overall. So we've got a slide for that later on in the slide deck. But another piece of news that we saw going to the bottom left was Fed Jerome Powell's last Fed meeting. That was on April 29th, so it just happened last week. It was his last press conference as Fed chair. I was digging into this. It really was anything but a quiet farewell. I mean, it seemed like at face, hey, nothing really happened because the Fed held rates at 3.5 to 3.75%, which kind of everyone expected. But what's interesting is the vote was 8-4. And if we look at the four dissenters, that's the most we've seen in a single Fed meeting since 1992. 35 years almost. And for the most part of Powell's 8-year tenure, he's been able to keep the committee pretty unified, even through some really difficult periods. If we go back to like the pandemic, even the 2022 inflation fight. And I think what makes it a little bit unusual too is when you look at the four dissenters, they were for different reasons, which I think is interesting. They didn't all want the same thing. One of the dissenters actually wanted a 25 basis point cut, while the other three were fine with keeping rates where they were. They didn't like the language that was used, which kind of framed the context that the next move would be a cut. So I think overall it tells us that, the path of interest rates is really genuinely unclear. And, we shouldn't just assume that rate cuts are coming at any specific timeline. And I think also when we look at the incoming chair, which is all looking like it's going to be Kevin Warsh, he's going to inherit a pretty divided committee. And I think that, it kind of does reflect how challenging the last couple of years were with all the different types of markets, from pandemic to, historically fast tightening pace where rates, went up very, very quickly. Then also we have tariffs, and now kind of inheriting a conflict between the U.S. and Iran, and what that, the implications there around inflation, as well as kind of an evolving labor market here in the U.S. That's one to really keep an eye on, because it's anything but probably a smooth transition now.
Could not agree with you more. I think when I read that transcript, it reminded me of the remake of The Wolf of Wall Street. He is not leaving. Now, there was some colorful language in the movie, but anyway, it wasn't in this
Hey, it
release.
might have been like that behind closed doors too.
That's right. Now, I could not agree with you more. I think Mr. Warsh is coming into a very, very dangerous situation. And when I say dangerous, I mean it's very delicate. One of the terms that I anticipate we're going to hear a lot more over the rest of this year is stagflation. And all that means is that basically the tools that they have access to aren't going to be able to help with what's going to be going on in the economy. We're going to be at a standstill. So we talk about inflation all the time, the increase in prices, but I can almost guarantee you over the next couple of months, we're going to start hearing more and more about stagflation. So just keep an ear out for that. We'll talk about it more as it gets more popular, but we're seeing it already, and it's going to continue to increase. And all of that leads us to our final key event for April that we saw, which was consumer sentiment and spending. And I know it was mostly negative. Jake, you did a lot of research on this, so you want to just give us the highlight there, or I guess low light in this case, of what consumer sentiment and spending did?
Yeah, it's kind of like a Charles Dickens tale of two cities here. Consumer sentiment kind of cratered down to below 50, which is really low, especially if you look at where it typically stands on a historical level, and also with how well the stock market's done. Even, it's been choppy this year, but we're in positive territory after, three really phenomenal years within the market. What came along with that is 1 year inflation expectations jumped up to 4.7%. So that's a lot higher than sort of where we entered the year from an expectation standpoint. On the other side of that coin, if we look at spending, it's actually come in pretty positive. So March retail sales jumped 1.7%. That was well above expectations. So consumers say they're nervous, but they're still spending. Given we're a consumption-based economy, the sentiment being so low could just be nothing at all. Could be a leading indicator that the spending isn't sustainable. That's something that we're tracking either way. But I think one thing's important is that, what people say and what they do are often two very different things. And people can say a lot of, difficult things or things that sort of don't align well with their day-to-day actions. So we want to look at, what people are actually doing, what corporations are doing. And of course, if folks are still spending, that should be accretive to, corporate profits, and vice versa. If that spending starts to dovetail off, that's where we'll really start to get nervous and sort of expect that corporate profits might not be very good looking into the future. So we're not there yet, sort of a poor headline, of course, but when you look into the actual data, it isn't really backing that up yet.
Yeah. Yeah. Great. All right. So let's move on to our next topic here, which is markets. So starting off with review of Q1. So this is looking through the end of March and heading into April. And what we saw was very choppy markets. We actually ended up, the quarter was down pretty much across the board. And what we're showing you here is the S&P, the Dow, and the NASDAQ. So that's the purple, the orange, and the blue lines. We've also got the international there, which was down just slightly. That's going to be your green. And then we also broke it up between growth and value. And the reason we wanted to do that was we wanted to show you the severe difference between growth stocks heading into this year after an extremely strong 2025 versus value, which had a good 2025, but not as good, but they kind of held up better through the first quarter of 2026. That kind of switched over a little bit. But Jake, before I jump there, do you want to talk about Q1 at all?
No, I think it's important to note, especially that growth versus value. We haven't really seen that happen in a while. The growth stocks have sort of dominated over the last few years. But this is why we have, diversified portfolios, so that not everything is in those technology companies, growth markets that have eaten up a lot of headlines and, have rightfully so because they've done really well. But, you get into a pullback period where some of those growth names were down 20, even 30% into the first quarter, whereas a lot of the value names held up a lot better. But Joel, why don't you bring us into the next slide, which then, gets us over this month, and we see this sharp turnaround where, the NASDAQ was up almost 18%. Those growth stocks up 17.5%, doing a lot better than the value companies. Now it's, we'll get into sort of an overall breakdown there, but certainly we saw over this past month technology rebound again, and it's not all loom and gloom for them, and sort of coincides with some of the earnings that we've seen as well. Joel, anything to kind of pick on here?
For me, it's two things. One is don't time it. We have no idea when this is going to happen. This is a 30-day period. And when you look at the overall market and like the history of the market, that is such a minuscule amount of time that you had to be right. That market timing, you probably would have missed this increase if you had gone based off of Q1's performance numbers. And two is rebalance. You kind of hit on it there a little bit. You want to remain diversified, but when you see big dispersions in performance, especially over longer time periods, like say 2024 and 2025, where growth just whooped up on value stocks, Rebalancing is going to keep you in line and keep you out of danger when you see these volatile periods with all of the things happening. And I think this is a perfect chart that leads into that of, hey, it was a rough Q1. 30 days later, you're feeling a lot better about it. But then we dive into, Jake, exactly what you were leading into was we wanted to dive into where is all of this performance coming and just kind of harping on that point further, which is you have to stay diversified. You never know what's going to work when, but we know that fundamentals of investing continue to work and they will continue to work into the future. So what you see here is over the last, this one, I love this number here. Over the last 5 years, if I had asked you, how significantly had large cap growth had outperformed large cap value on a percentage basis? What do you think would that have been? And I'm willing to bet most people would say it's a pretty high percentage. Probably, growth did 20-ish% and value did something like 8. They're actually much closer than you think. So if you look here on this screen, over to the far right of that top chart, over the last 5 years annualized, large cap growth did 14% per year, which is fantastic. It's definitely higher than like normal annualized returns for a 5-year period. We're happy to have it. Value did almost 11. There was a lot of volatility in between those two periods, but at the end of the day, again, panning out from what we just saw between Q1 and a month, panning out to 5 years, it's actually been much closer than I think most people would have anticipated. And if you were rebalancing the entire way, you would have caught both of those waves. You would have had the 2022 down year where value held up better. And so this just kind of reiterates for me, staying diversified, even in the large cap space, makes sense. The other thing, again, going back to the rebalancing, 2024 and 2025, big years for large cap growth. Rebalancing out of those names and not letting the tax tail wag the dog will help over the longer term. And so you need to be tax aware, but do not let the tax tail wag the dog, because over the long term, it's better to stay diversified than trying to just ride the hot hand over the long period, over the long term. So that was a lot of talking, Jake. Anything to add on that or anything else you want to talk to before we jump to some of the other charts here?
No, I mean, there's so much to talk about on this slide. A lot of really great ways to look at, especially when someone asks you, like, how's the market doing? It's like, well, which market? There's so many different ways to kind of skin that cat. I think if we look at the bottom in the middle, which looks at the sectors, how each sector is doing this year, energy up about 35% year to date. I think that's really important as we look at how the value stocks are doing versus the growth stocks. Because for the Russell 1000 value, that's, for large cap value stocks, energy is about an 8% position within that index and virtually nothing with growth stocks. So that right there is about 2.7%, kind of explains 2.7% of that outperformance of the value over the growth on a year-to-date basis. If we look at, how value versus growth is done year to date, the value's up almost 8% versus the growth up about 3%. So it explains, about half of that. Also looking at that sector, technology stocks are still doing pretty well, up 13% this year, right? So it hasn't all been loom and gloom, right? With these tech companies, a lot of that has happened over the last 30 days, though, right? As we just saw.
Yeah.
But I think also, looking at the region snapshot is important too, and that's at the bottom right. If we look here, how the U.S. stocks are doing versus the international markets, you really start to see that, hey, we're not doing all that well. U.S. stocks up 5.7. Some of these other markets, like emerging markets, up about 18%. Latin America and Asia Pacific, all having pretty solid years. And again, it gets back to the diversification story. Like, this is why we own, such a large chunk of international stocks. You've seen it now in the last 18 months, whereas international had really lagged over the last couple of years. And I couldn't agree with you more about the rebalancing side of that coin too. If you are diversified but don't rebalance, you're going to have a portfolio that's no longer diversified after a couple of years, especially if you get into some asset class having a bull market run or a significant pullback, it means that, those securities that do really well are a larger and larger portion of your portfolio, and the asset classes that don't do very well become less and less. So you got to have both of those working at the same time. And if you do, you will get portfolio results that work over time, even though in any given period, you might not look as good because everyone wants to be in the asset class that's done the very, very best in any one period. You're never going to be able to predict that in any given period. And so the next best thing you can do is just have an all-weather portfolio that's going to maybe not do as well as the number one returning asset class, but over time it will produce, really strong results that beat inflation and hopefully, allow you to reach all of your financial goals.
Could not have said it better myself. And then the one last thing before we leave this slide, I think it was great that you hit on that region exposure right there. If we just talked about how awful it is what's happening overseas across the globe at this point. We only touched on Iran, but of course we still have what's going on in the north of Europe. If how would we have possibly assumed that emerging and international stocks would have been the outperformer over this time period? I wouldn't have made that bet, but it just goes back to show you that you never know what the markets are going to do. The markets are a long-term voting machine, and right now they're voting that, hey, there's still some value to be had out there in the international markets. So I think we harped on that point enough. Rebalance, stay diversified, and we're trying to achieve your goals, not the highest returns possible. So I think that's all valid points. So let's jump over and let's check in on our holy grail here. So this is one of our favorite charts. We're going to spend a little more time here because we've got some flashing signs that we want to make sure that we spend plenty of time talking about. We're going to start right up at the top there. So first and foremost, housing starts to actually continue to be a positive sign. We've actually seen a pretty good uptick in what that's been looking like over the last few months. So that's good news for the economy. But then the one right below it, that O there, oil prices. Massive surge. Now, this is the WTI, so West Texas oil prices. We've seen over the last 3 months it go from $64.50 a barrel to the most recent reading at just under 100. And this is actually a little backdated here. That is a 55% increase in WTI crude oil prices. At these levels, they are getting to the point where we are keeping a very close eye on this from an economic standpoint, because like we talked about earlier, this leads into all the other data points, most namely inflation, but also consumer. I was fortunate enough right before all this happened to have traded in my Tesla for a Suburban because I'm a family man now. Could not have possibly timed that worse because I went from paying $3 a gallon the first time I filled it up to now it's $4 a gallon every time I fill it up now. I'm feeling it at the pump. So from a consumer standpoint, I'm having to cut back elsewhere. I'm not the only one going through this, but it's a good example of kind of how this seeps into the other parts of the economy. And if we stay at these elevated prices longer, we're going to continue to see that hamper consumers. And like Jake said earlier, we are a consumer-based economy. So if it's going more towards staples like oil, we have less to spend elsewhere. Jake, what are you looking at when we see this chart?
Yeah, I mean, every one of these we can key in on and have a good debate over. For me, I think if I look at inflation is showing up as yellow again. We're starting to see the shock from oil seep through a little bit. CPI was 3.3% in March. That's the highest in almost 2 years now. So we're still watching that really closely, but I think the real effects from this aren't even in CPI yet. So that's one to really keep our eye on. I think the other one too is retail sales. This is one that's showing up as green, up almost 2.7% over the last 3 months. Consumers are still spending, but this one worries me. Even though it's green now, I think that what you talked about there, Joel, about just the wallet share, it's going to have some stress on it. I mean, we're still going through it with just even grocery prices and home affordability, right? Those were sort of issues that were last year's, but we carry them forward into 2026, of course. And now we're having more pain at the gas pump. So I think ultimately it has to sort of lead to some sort of pullback. And I would be curious to see if retail sales continues that green path forward. To me, it seems a little bit shaky. And then, of course, looking at the lone red on the page here being loan delinquencies. You know, statistics is always funny. You can make the numbers read whatever story you want. You know, for example, I could say that loan delinquencies are up over 25% from 1 year ago, and that could make headlines. But if you look at it, still at very, very low absolute levels. And I would say that that's one that maybe we're focused on. That one doesn't seem as alarming to me as the inflation, oil, and what's maybe going on with retail sales into the future. So, you know, overall, I see a lot of green on this slide. I see a good bit of yellow, just kind of neutral, and only one red. So at face value, you know, you might look at that and feel pretty good about the economy, but I really start to see this being a little bit shaky, being positioned for, you know, what's to come into the future, especially if oil prices remain high. So this one worries me a little bit more than kind of previous ones have. Joel, I'm curious if you feel the same way or if there's maybe a silver lining to take from this.
Yeah, I think the silver lining is that there is still more green. But
Yeah.
there are definitely some warning signs here that we are keeping a close eye on. And the one that we didn't talk about, but does relate directly back to the Fed, is that 10 to 2 year spread. And so what we're looking at there is, of course, if I'm confident that I can loan money for 10 years, I'm expecting a higher rate on that. But if I'm not as confident, I'm going to ask for a higher rate on the short end. And we've seen that 10 and 2 year spread condense pretty drastically, relatively speaking, over the last month or so, as we would expect. So again, fun with statistics, it's contracted by over 30% over the last 3 months. But even over the last year, while it's healthier than it was, this is something that we're going to keep an eye on as we move into this new Federal Reserve regime, see what happens with overseas, and all of those other data points that we just talked about. When we look at this chart, we kind of make it seem like they're all independent of each other, but all of these work so very closely together that it's something that you have to look at as a mosaic and kind of take it all in as a whole picture and say, okay, how are we feeling about things? I personally am still very positive on the overall economy, and I think that we will get through what is currently a relatively difficult time, especially if you have the TV on right now. But personally speaking, I think the US economy is resilient. I think it's strong. I think there's a lot of positives happening right now. And I think there's a lot of things coming out of the companies that we follow that is very positive for us, which just so happens to be a great lead into our slide here on key earnings in April. So, Jake, I will let you take it away. What did the big tech names tell us over the last couple of weeks?
Yeah, we've got kind of three companies we'll talk about here and then kind of just a broader takeaway. What we saw last Wednesday on April 29th was that basically all the big AI names reported on the same day. So that makes things fun. Some good, some bad, not a whole lot of ugly, but some of the stock prices reacted that way. Let's get into it first off with Alphabet, which is the parent company of Google. If you look at kind of the headlines, revenue was up over 22% year over year. Profits were up over 30%. I think the standout by and large was Google Cloud grew 63% and it has a backlog currently of 462 billion. That's again the value of contracts that they've signed but just haven't delivered yet. That almost doubled in just one single quarter. And so if you paid attention to what the management discussion was sort of after the results were posted, they talked multiple times about being quote unquote compute constrained. What that means is that they can't build data centers fast enough to meet the demand that's being spurred by AI and by Claude, OpenAI, et cetera. To that point, they raised their capital expenditure guidance to about $185 billion for the next year. And you'll start to see that being a trend of, hey, we are seeing this massive amount of demand. Now, luckily, you know, Google has sort of a cash cow business where they have this recurring cash flow stream coming in. They can make these strategic investments, but you start to see that as a trend that the capital expenditure are not slowing down anytime soon. Google was one that was a standout post earnings in that the stock price was up, I think, like over 8% that day. You know, really a lot to take home. And especially at the scale that these companies are at, to see a backlog, almost double in a single quarter. It's just pretty staggering. The next company to focus on would be Amazon. Net sales were up 17%. If we look at AWS, which is Amazon's cloud business, they grew at 28%. And that's the fastest pace of increase over the last 3 years. And again, right, like at the scale they're operating at, the growth is accelerating. It's very, it's a good thing to see as a Amazon shareholder. Also, advertising up over 24%. They raised their capital expenditure guidance to $200 billion for the year, so even a little bit more than Alphabet. And the stock actually traded down a few percent on this print because investors are starting to ask like, hey, when does this spending actually convert to profits? They didn't quite have the same pop that Alphabet had, and that's a place that investors are still getting cautious around, and that's just this continual investment that we're talking about hundreds of billions of dollars here. So one to keep an eye on there, but overall a really strong earnings announcement, and the company certainly is humming along quite nicely. Another common AI name that you just always think about, artificial intelligence, NextEra Energy. No, I'm just kidding. But our clients know NextEra well, and if you're a Florida resident, you do too. They're a utility company. They have Florida Power and Light, one of their regulated businesses. What a lot of people might not know about NextEra, though, is they're the largest renewable developer in the entire country. So they had reported earnings as well. Profits were up over 10% year over year. What's interesting, they added a record 4 gigawatts of new renewable and storage projects to their backlog this past quarter. And so that matters because all of that AI demand that we just talked about, that all requires a massive amount of electricity. And so NextEra is essentially, selling the picks and shovels to that build out and supplying that power generation. They also reaffirmed their guidance. They projected dividend growth of around 10% this coming year. So, on the value side, just because you're in value companies or dividend companies doesn't mean, you have to be on the sideline for this, energy or for this AI infrastructure build out. You can still partner with companies that are investing right alongside there, and they might, not come from industries or sectors that you would, tend to think about there. So that's kind of the 3 companies we picked on there. NextEra did well after their print, but I think there's kind of 3 takeaways from a general broad takeaways here. The first being that the AI demand is real. It's not fading. A lot of folks are calling it a bubble. If it is a bubble, it certainly hasn't popped yet, and it's continuing to expand. I don't think it is. I think that there's going to be a time where there's a rotation out of the hardware names and even out of like the hyperscalers into maybe platform companies that are using AI, or just like plain old businesses that are incorporating AI workflows into their processes and becoming a lot more efficient because of it. So, it's not going to surprise me, and it will come when, these companies stop spending hundreds of billions of dollars to build out AI infrastructure. That's going to happen. But, to call it a bubble, I think is missing out on what the transformation will look like. It's not something that is just going to go away. Mm-hmm. Number 2 is that CapEx is the new battleground. Every one of these companies beat on revenue. Like that was not in investors' mind when these companies reported earnings. Is like, oh man, is AWS or is Google Cloud gonna continue to grow? No, of course they're gonna continue to grow. That's kind of table stakes at this point, which is a little bit scary. Every one of them raised their spending though. And the CapEx is now, what investors are focused on. It's what's driving whether the stocks are up or down. It's like, hey, that's great that you're still seeing this demand and you're continuing to build out, but when is that going to come back and earn some ROI, some return on investment? And that's really where investors are pushing that buy or sell even more so than, hey, is our earnings growing? Is revenue growing? The fundamentals are all in really good shape. The third one is, hey, don't forget about the picks and shovels. Everyone talks about the AI themes as being within NVIDIA, being within, these hyperscalers like Alphabet and Microsoft, Meta, et cetera. But you don't have to go to the market and pay 30 times earnings for a semiconductor name or a hyperscaler to get exposure to AI markets. You can go on the power and infrastructure side, which is a really compelling part of that story, and you can do so with even some of the value companies that you might not expect. So
Mhm.
I just said a lot, Joel. Anything stick out to you there? Anything you want to comment on?
No, I think you nailed it. The only thing I would dive into a little deeper is one of the things that we do look at when we're researching companies, and we'll pick on Google for a second here, is the actual management team. Because at the end of the day, we're relying on them, us as investors, for them to be good, what we call capital allocators, using the dollars that we're giving them in the best place possible. Right now, that's all about AI. It's all about data. That's going to lead into energy, which I think is perfect for you picking NextEra there because those play together right now. But Google, if you'll remember back just a couple of years, was kind of put out to pasture when this whole AI boom started to take off, which is ridiculous to think about now. But they pivoted so quickly that they've since made up and are now one of the leaders in that space. And so you got to give Sundar and the entire management team over there major kudos for being able to make that pivot and do it quick enough that the stock has really rebounded pretty well since those bottoms. And again, it's just ridiculous to even say that they were kind of AI laggards back now that they have their Gemini and all the other models and things that they're working on. But also, fun fact, everybody has been hearing about SpaceX and all these massive IPOs that we're anticipating through the rest of the year. Very hard to get into, almost impossible, virtually impossible. It's impossible. But fun fact, if you had owned Google, you own a little bit of SpaceX. So again, having these management teams be good capital allocators of the capital that we're relying on them to manage for us is a big part of stock investing. And it's one of the things that we do focus on when it comes to putting our money to work with these great companies. I'm excited to see where it continues to go. The one metric, I think you hit on it well here, Jake, is that return on capital. I'm okay if you're spending these dollars, but I need to see a return on it. If I'm not seeing the return, you are purely just burning money. And at some point, that has to come to a head. And so there will be winners and losers here. We're trying to pick the winners, of course, and we're always making sure that we're moving our capital where it needs to be. But there will be losers in this space. I don't think it's going to be the Amazons or the Googles of the world, but you do need to understand what you own right now. And I'm a little worried about the meme culture might be coming back here again, chasing those performance and the hot names in the space. So just make sure that the money that these management teams are spending on your behalf, you're seeing those return in dollars. Valuations still matter at the end of the day. So we can justify a higher valuation in the short term if I can see the long-term value that's being created. But if there's no value being created, I don't want to have my money with you. So it's one of the things that we look at pretty strictly, and it's one of the fundamental things that we look at when it comes to investing here at FourThought. So anything to add to that, Jake, before I kind of sign us off here and we move to our Q&A?
No, well said. Yeah, let's move into the Q&A.
All right, great. Well, thank you everybody so much. As always, if you know anybody that you think would value this conversation that we have every month or has some burning questions that they would love to get answered, please feel free to either share the link with them, send them our way. We're happy to get them signed up for these as well. The more the merrier. We love doing these every single month. And I'm sure we have some great questions that came out of today's session. So let's move over there and get those answered for you. All right. Good morning, everybody. Thank you so much for joining Jake and myself today. Hopefully that was informational. And we did have a couple questions actually before our presentation today that we wanted to get over to. So you still have a chance to get your question answered. If you want to go down to that Q&A box at the bottom, feel free to send it our way and we'll get through as many of these as we possibly can. So Jake, first one that came up was we talked a little bit about inflation potentially higher for longer inflation. We can use the words transitory and bring back those memories if we really want to. But if we do get higher inflation than we anticipated, above that 2% target from the Federal Reserve, what asset classes or what should people be thinking about their portfolio as far as positioning goes for the rest of the year if that becomes the case?
Well, first off, inflation has a huge impact on financial plans. It's one of the main assumptions that goes into that plan. When I think about inflation, I think about expenses, right? So that's critical on the financial plan itself. That will move the needle. But when I think about investments and what type of sectors or stocks tend to maybe hold up a little bit better, I think about the company's expenses. So, for example, what companies have sort of very expenses that are highly tied to, for example, like energy. So airlines would be like a great example of that. That's going to be a huge part of their total cost structure. And if they see inflation creep in there, if they haven't kind of hedged it fully, which most of them do not, they might have a tough time. But really, it comes down to, is the company able to pass through the increase in their expenses? Do they have pricing power? Typically, we find that companies with a strong moat have the ability to pass through prices. And sometimes it's companies that are producing some sort of good or service that's a very low percentage of spend for another business or for a consumer. So those companies typically are able to pass through that pricing. But to kind of keep it general, I think real estate tends to do well when we get into an inflationary environment, especially again being able to increase rents along the way there. They tend to hold up well. Energy tends to do well because a lot of times, that's a driving sort of overall CPI. So they tend to do well. I would say, what tends to not do well would be cash. That right there just erodes the purchasing power of cash. And also traditional fixed income. If you think about if you have a bond that makes fixed payments to you every, semi-annually, usually, the purchasing power of those interest and then eventual principal payments is getting eaten up by that inflation over time. So if we were to see an environment where we thought that might persist for longer, what we might look to do, obviously, we want to make sure that like your spending's taken care of over the next 5 years with a solid bond ladder. But in the event that that's covered, we might look to actually invest in some of commodities, MLPs, things that tend to do a little bit better when there's an inflationary environment. Equities tend to do better than fixed income, for example, alternatives as well. So that's kind of how we would look to maybe tweak the portfolio at the margin. We're never gonna make a wild swing and bring bonds down to zero because we don't have that crystal ball. But those are the kind of general lines of thinking that we go through from our investment committee. Joel, happy to pass it back to you to see if anything you want to add on there.
Yeah, agreed. One of the things that ends up happening, so we call it real return, right? Your nominal return, let's say it's 4% on a bond, so that's your quote unquote locked in return. If inflation's running at 3.5%, your real return in our case would be only 0 to 0.5%, which for going back to the financial planning, that's just untenable. You're right, it's getting eaten up by that inflation if it does stay higher for longer. What that tends to lead folks to do is lean into the more risky asset classes in a search for yield. I remember when I first started doing this, bond rates were basically zero. Luckily, inflation was too, but you saw portfolios much higher on the risk scale because there was no alternative. Fixed income just wasn't giving you the return that you needed to achieve those long-term goals. I'm a little concerned that we would get into that environment again. It's one of the things we do keep an eye on. You're right. We use bonds for a very specific purpose in our portfolio. That purpose does not go away in a high inflation environment. But what might lead investors to do is taking on more risk than what they might be comfortable with, and helping them to understand what those risks are in that environment is something that's imperative for us to do as we're making those changes and keeping an eye on things as they move around.
Yeah, and part of it too is like what as a portfolio, that's comprised of investments, at the end of the day, these are sort of the vehicles that should help you hopefully bring you towards your financial goals and your financial objectives. So, in the event that we have inflation that's going to be different than what our long-term expectation is, we would want to model that into the financial plan first to kind of see like, hey, are we still on track or not with the given investments that we have? But then the second part of that becomes like, okay, now do we need to look at tweaking the lineup or tweaking the vehicles that we have at our disposal to get us there? And there is that trade-off, Joel, of like, hey, if we're kind of coming up short here, we need to have that honest conversation, and that's where the real planning comes in into play. And there is a give and take. If we wanted to take on no risk, we would just sit in treasuries. But we know that over the long term, that's not going to help us, reach our goals. So you have to take some risk. And so the balancing of that risk versus the expected return opportunity there is something that is crucial. And inflation plays a huge part in kind of both of those aspects.
Yeah. Yeah, absolutely. Absolutely. Couldn't have said it better myself. Well, we are coming up on our time here, folks, today. Again, thank you so much for joining us. As always, happy to send this link to anybody you think might enjoy the conversation with Jake and myself. We try to keep these to about 45 minutes, so we did good today, Jake. So thank you, everybody, for participating, and we will see you again next month when we do our next rendition of Coffee with Forethought. Have a great day.
Take care.